Hello, everyone. My name is Ambrogio Cesa-Bianchi, and welcome everyone to the session New Developments in the Global Debt Markets. This is a session organized by Galina, Hale, who's also connected from the Federal Reserve Bank of San Francisco and the UC Santa Cruz, and myself from the Bank of England, and also, and this is a session organized by the CEBRA International Finance and Macro Group. So again, welcome to all the panelists and all the attendees. We have 4 presentations in these sessions. We're going to structure the session with 4 presentations of 25 minutes each, and we're going to leave 5 minutes for questions at the end of each presentation. If you have questions from the attendees, please feel free to use the Q&A box. You can ask either clarification questions or general questions. We'll try to ask the former during the presentation, and we're going to ask the latter, the more general ones, during the Q&A at the end. I think that's all from me. So let me introduce the first speaker and the first paper, which is titled Differential Treatment in the Bond Market, Sovereign Risk and Mutual Fund Portfolios. The presenter is Converse from the Federal Reserve Board. Nathan, the floor is yours.
Thank you to Ambrogio and to Galina for chairing the session and organizing, and particularly to Galina for tuning in at a very early time, West Coast US time. So I'm going to talk about how fund managers of bond mutual funds modify their portfolios in response to changes in sovereign default risk. And before I go further, I should add 2 caveats. One is the usual that the views in the paper are those of the authors and not anyone else at the Federal Reserve Board. And second, that we got a great set of reports from some referees back in May. And if those referees are in the audience, please don't take this as a sign we're throwing your comments in the bin. It's been, as you might imagine, a busy summer policy work-wise at the Fed, so we haven't incorporated all those comments yet, but thank you very much if you're here. Okay. So the motivation for this project was really twofold. One, from the empirical side, work on the dynamics of mutual fund portfolios, or has tended to focus on just responses to changes in yields without unpacking the factors that we know drive those yields, for example, sovereign default risk. And so we're just kind of going under the hood and looking at how the portfolios respond to factors behind risk. And the second was that there's this very large and ever-growing literature, theoretical, I guess you could characterize it as theoretical or quantitative macro literature on sovereign default, following in from papers by Ariano and co-authors. That tends, with some important exceptions, tends to model foreign creditors in what you might call a fairly simple or being harsh, uninteresting way. Risk neutral, deep pocket, price setters, without really looking at whether this is true. So the other motivation for this paper is just let's look at how an important class of international creditors, bond mutual funds, actually behave. So concretely, what we're going to do in this paper is look at how fund managers modify their portfolios in reaction to changes in sovereign default risk. And then we're going to look at how the sensitivity of their portfolio shares varies depending on the characteristics of the country in question. So is it different for developed versus emerging markets? Is it different in depending on the country's what you might call fundamentals? So does a country, for example, have high debt versus low debt? And we'll go through a list of other fundamentals that we check out. And then finally, how does sovereign default risk in one country affect portfolio allocations to other countries in a fund's portfolio, and putting it in a more flashy way, or you might say that you can say that we look at do bond mutual funds contribute to cross-country contagion. So to answer these questions, we create a new data set merging, on the one hand, micro data on the cross-country portfolios of individual bond mutual funds, almost 500 of them, over about 15 years at the monthly frequency. And we merge that with data on sovereign default probabilities, which we extract from CDS contracts. And we look at how those portfolio allocations depend on the default probabilities that we extract. So we find that fund managers do indeed reduce their exposure to countries with higher default risk. Not super surprising, but as I'll get more into the details, we do condition throughout on yields. So this is saying that changes in yields do not fully compensate fund managers for their for changes in default risk. We also find that funds are more aggressive in cutting their exposure to emerging markets and peripheral Euro area countries, as opposed to what we're going to call core developed markets. We find that countries with weaker for countries with weaker fundamentals, fund managers are more aggressive in reacting to changes in portfolio risk. And also, this sensitivity is larger for countries with relatively small weights in the portfolio. And then third, kind of I think the finding that we find most interesting is that what we call core developed markets, so Western Europe, the US, and Japan, there's essentially no sensitivity of the portfolio weights to changes in sovereign default risk. And this insensitivity is not explained by stronger fundamentals. So our initial thought was just, well, this just reflects the fact that like the sensitivity of portfolio weights to default risk is lower for countries with stronger fundamentals. These core developed markets have stronger fundamentals, but even when we control for those fundamentals, this what we call preferential treatment is still there. And I'll talk about this in some detail. And then last but not least, when it comes to cross-country spillovers, so as in some sense must be the case, given the results I just presented, when managers reallocate away from risk in one country, they increase their weights in other countries. That mathematically has to be true since they're portfolio shares. But where do they tend to go? They tend to go out of the region where the country is located. So if default risk goes up in Indonesia, they tend to also move out of Thailand. Excuse me, sorry, I said that wrong. If default risk goes up in Indonesia, they tend to reallocate from Indonesia to countries outside of emerging Asia. That said, we don't find evidence of contagion except in Latin America. So sort of going back to the example I just used, default risk goes up in Indonesia. They do not allocate out of Thailand. They keep their Thailand allocation the same. The money they move out of Indonesia goes out of the region, but they're not going to change their portfolio allocations to other countries in the region. And the exception here is Latin America, and that's actually consistent with evidence, the previous work that shows that there is contagion via bond mutual funds in Latin America, but one contribution of the paper is to show that this is a Latin America specific phenomenon. And then last, that when they reallocate, they do not reallocate into risky countries with high debt. So the money is taken out of a country where the default risk has gone up and put into relatively safer countries. So I've pretty much already talked about this, and I'm running tight on time, so I'm going to skip over this. So we take our data on sovereign default probabilities from market. We have data on 27 countries. To input, we extract from CDS contracts these sovereign default probabilities using a methodology developed by Pan and Singleton in a 2008 paper. To implement this, we need CDS spreads for bonds of 3 maturities, sort of giving an extremely vague and rough intuition behind the method is that if you have these CDS spreads for bonds of a variety of maturities, there's enough the parameters and other factors. The other parameters in the equation are constant across the yield curve, and so you have enough equations to be able to extract the implied default probability if you have these at least 3 maturities. So given that, we extract the default probabilities implied by these CDS contracts, and then we merge that, as I said a few moments ago, with monthly frequency data on individual bond mutual funds portfolios, which we get from a commercial data provider called EPFR Global. And concretely, we're going to have the weight of a country in each fund's portfolio at the end of each month. So the data, the portfolios are at the country level; they're not at the security level. We get a lot of comments saying that we should go to using Morningstar, which provides data at the security level. Morningstar data is at best quarterly, and CDS spreads and default risk moves at a fairly high frequency. So feel that it's important to get some higher frequency dimension. The highest frequency that I'm aware of, as someone that works with mutual fund data for portfolios, is monthly, and so that we felt it was important to get a higher frequency data set. And then we're going to, as I said earlier, we're going to control for returns throughout. We're going to use just MB spreads or MB total return indexes to control for returns in each country. Okay, so here's the average default probabilities that we extract from the CDS contracts. Unsurprisingly, Argentina is a huge outlier, but I do want to just kind of, the emphasis here is that one, that default probabilities are not 0 even for Germany, much less the US. So this there's interesting variation among advanced economies, not just from advanced economies versus emerging markets. Here's a time series plot of the default probabilities we extract for developed markets. And again, kind of wanted to make the case that these default probabilities for core developed markets are interesting and do vary. So the heavy black line here is the US, and you can see, for example, in May 2011, when there was the S&P downgraded the US because of like budget negotiations, default risk went up. So just really emphasize, because of this preferential treatment result I'm going to show you, a lot of people are skeptical, like, do these default probabilities of of developed markets, are they meaningful? And I think this time variation indicates that it is. Here's just a quick snapshot of the portfolio of the assets of the mutual funds in our portfolio, just in terms of dollars. On the left panel, this is by where are these funds investing. So there's a good variety in terms of emerging markets across different regions, but also in Europe and the US. And in the right panel, just the comment here, and another nice thing about the particular mutual fund data set that we use, it has good global coverage, and so we have mutual funds, say, not just in the US, the red portion of the right-hand panel, but also in Europe, tending to be in Luxembourg, and also Ireland, the blue and the green. And then we do have funds domiciled elsewhere, but the lion's share are US, Luxembourg, and Ireland, but a good picture of the global industry. So we end up with a data set of 460 funds over a 15-year period ending in 2018. 14 emerging markets, 13 developed markets. We also have the cash allocation of these funds. And this gives us more than 165,000 country month observations. In what I'm going to talk about, we often refer to this category we call the core developed markets. I just want to list those here briefly for you. So essentially what you might think of as developed markets, but excluding peripheral Europe. And this kind of distinction we came about kind of in the course of our research, that when it comes to this relationship between portfolio shares and default risk, the peripheral European economies really look much more like emerging markets. It's not that's not kind of a value-laden comment. It's just kind of an empirical distinction we made, and so it was useful to talk about these core developed markets in our analysis. So to do the actual analysis, we derive a specification following kind of a method or a technique used by a much cited paper on mutual fund portfolios by Raddatz and Schmuckler, 2012. Which basically takes just an accounting identity, the law of motion for portfolio weights, which will depend on capital flows and return differentials, and then allow capital flows to respond to return differentials and kind of what we add to the analysis, sovereign risk of a country relative to the other countries in the fund's portfolio weight. So our key measure of sovereign default risk in our empirical specification is going to be this lambda JT, so default risk in country J at month T, relative to the average default risk in all the other countries in the fund's portfolio, and that it's going to be an average weighted according to the previous period's asset allocation of the fund. So this is why the average default risk in the portfolio is fund specific, while obviously the country default risk is not fund specific. So here's the regression that we run. The portfolio weight of fund I allocated to country J in month T depends on the previous period's portfolio weight. Portfolio weights are very persistent. The relative return on country J relative to the average return in the fund's portfolio. And then, as I just said, the relative default risk. This is what we throw in that's new. And then throughout, we're going to control for interacted fund country fixed effects, which will catch any kind of a preference, you might say, of different funds for different countries, and also time fixed effects, which is important because there is there's a strong common component in default risk across countries, and this is going to extract that. So we're really going to be looking at country-specific variation in default risk. Okay, on to the first result. So column 1 here. So our result here in the third row is that when relative default risk is higher in a country, bond mutual funds allocate less of their portfolio to that country. So not groundbreaking here. That seemed like common sense to me, but I think it is interesting in the fact that we control for returns in that country. So this is again finding that fund managers are not fully compensated by changes in returns for extra default risk, and so when default risk goes up, they allocate away from the country. So the next, so this is like the baseline specification. The sort of big focus of the project is on heterogeneity in this reaction, the sensitivity of portfolio weights to default risk. And so the first heterogeneity we considered was just geographic. So separating out core, again, what we call core developed markets from emerging markets and peripheral Europe. And we find that the portfolio weights of these core developed markets are significantly less sensitive to changes in default risk. So this is the significance of this interaction term of a dummy for core developed markets and our default risk measure. So we thought, okay, this is probably just attributable to fundamentals. The next exercise we did was we examined in the paper, we examined in great detail one by one how the sensitivity of portfolio weights to default risk varies according to these different fundamentals. Here I'm showing you the coefficient estimates, and I thought it was a little more interesting for a presentation like this to plot them rather than show you another table. These are the coefficient estimates for countries with different characteristics. So just for example, so the line is the average effect that I just showed you in column 1 of the last table. Then here in the kind of what you might call the first column or the first bar, the diamond is the point estimate for the sensitivity of portfolio weights with respect to default risk for countries with a high level of default risk. And then likewise, the second bar is the point estimate, the coefficient for default risk for countries with high levels of debt, and so on. So as you might expect, high risk countries, high debt countries, portfolio weights are more sensitive to default risk than countries with high financial development. The portfolio weights are less sensitive. Something we thought was interesting and was significant throughout our analysis was countries with high initial portfolio weights. The portfolio weight is less sensitive to changes in default risk. We didn't dig into this in detail in the paper, but this seems consistent with funds, kind of the countries that they have big allocations to. They have, say, more specialized knowledge, and so they're kind of more sure about their allocation there and are going to react less to changes in the market, changes in this market price of default risk. And then in the last bar here, so this is the coefficient, the sensitivity for core developed markets, and this is controlling for these other fundamentals that I've talked about in this graph, and some other ones that I mentioned in the note that for the sake of time I won't get into. But we really threw kind of the kitchen sink, trying to kill this effect of being a core developed market and core developed markets being insensitive to default risk. It doesn't go away. So the confidence bands here I'm showing are the confidence bands with respect to this average effect. As you can see, core developed markets, the default risk is the sensitivity of the portfolio with respect to default risk is very close to zero and significantly below the average effect. So this is what we have called preferential treatment. Independent of any fundamentals, the portfolio allocations are really relatively insensitive. Okay, and moving to the last part of the paper, we wanted to look at how, so we've seen that fund managers, when default risk is higher in one country, they allocate away from that country to somewhere else. So the next part of the paper is about where do they go when they reallocate away from that country. So what we're going to do is modify the specification and break up that relative default risk term into two separate terms, which are in red on the slide. So the country, we have, same as always, the country's default risk, but now we're going to look at how the portfolio weight changes in response to default risk in the rest of the portfolio. So the average default risk in the rest of the portfolio, the second term in red. And so a gamma 1 greater than 0 implies, so this is what you'd expect, and in some sense, roughly has to be mathematically true. When investors go away from country I, they have to go into some other country J. And so reassuringly, given that again in some sense has to mathematically be true, we do see that when default risk goes up in country J, investors move into other countries. That's what I've called the baseline on the left-hand column here. This is not an interesting regression, but I show that just to fix ideas before I move on and start looking at heterogeneity in that reallocation where investors are going to. And so there, in the bottom two rows of the table, we look at how do investors react, how do investors adjust their allocation to a country when default risk goes up within the region in which that country is located, and then outside that region, the country is located in the bottom row. So I think this will become clearer when I just talk through these results. And the sort of most eventful one here is the Latin America, so the middle column of the table, that I've drawn attention to with the red. So here, if default risk goes up elsewhere in, let's say, elsewhere in Latin America, investors pull money out of other countries in Latin America. So if default risk goes up in Argentina, investors pull money out of Brazil and reallocate to other countries outside of Latin America. So that's not true for any other regional grouping we look at. So for any other regional grouping we look at, when default risk in one country in somewhere in the region goes up, investors do as per our previous results, pull money out of that country and take it, and they do take it out of the region. That's what the bottom row is telling us, why the bottom row is always significant. So they move the money out of the region, but they leave their portfolio weights to the other countries in the region unchanged. And so that's in this second row from the bottom, this lambda IN group that I've called, that I've said here. That's why this is not significant for any region except Latin America. So this contagion happening in Latin America is really the exception to the rule. And so the coefficients in other emerging market regions are negative, but they're very small and very far from being significant. And then I'm just wrapping up. So apart from geographic characteristics, in terms of the other, what we've called fundamentals elsewhere in the paper, so fairly intuitively, what we find is that when default risk goes up in a given country, investors reallocate away. They avoid reallocating into countries with high risk. Sorry, that's actually, no, it's the reverse. So we get a positive coefficient, so it looks like investors reallocate into high-risk countries. This is kind of an artifact of our methodology that we're looking at always relative risk. And so if relative risk in the portfolio, if the average risk in the portfolio goes up, a given country becomes, the relative risk goes down because the average risk elsewhere has gone up. So that's actually not a very interesting result and kind of a mechanical and strange result of our methodology. But looking at other fundamentals, as you'd expect, so investors reallocate, they reallocate avoiding high debt countries. They tend to reallocate into countries with high levels of financial development, and they tend to reallocate into countries with relatively large portfolio weights. So yeah, investors avoiding kind of overall less countries with weaker fundamentals when they reallocate away from risk. We do a number of robustness checks in the paper. I think I have about 2 minutes left.
Sorry to interrupt, Nathan.
Yep.
You're over time, so if you can wrap up.
Okay, great. That's good. I'm done.
You can have a few seconds if you want.
Okay, I know you said you were going to be strict on time, so so just to restate the results, we find that fund managers reduce the portfolio allocations to a country when sovereign default probability increases. We find that the intensity of that reallocation depends on the fundamentals of the country, but at the same time, for what we call core developed markets, there's this preferential treatment in that sensitivity is very close to zero for these countries, and that's independent of any fundamentals. And last but not least, we find little, if any, evidence of contagion outside of Latin America, but investors do tend to reallocate, taking into account the fundamentals of the places into which they're moving their money. All right, thanks for your time.
Thank you very much, Nathan. So we have time for a quick question from either panelists or attendees. I might ask a very quick one, Nathan, on something that I was wondering while you were presenting is whether you think of these mutual funds as being homogeneous, meaning having the same attitude toward risk or facing similar constraints if they have any. So the question is, do you assume that in your specific, to interpret your specification, and it's also a curiosity really whether I should think of these mutual funds as being heterogeneous in some dimension, let's say someone facing a tighter constraint than others, or someone being more risk averse than others?
Thanks. Yeah, we definitely do not think of them as being homogeneous. And in the paper, we have a short section where we do explore heterogeneity along the dimension of characteristics of the funds. I don't talk about it in the presentation because it fits a little awkwardly with the rest. But I think with it, like the most interesting one we found is that mutual funds that are affiliated with banks tend to be more aggressive in pulling away from risk. So that was probably the standout result there in terms of heterogeneity, that those mutual funds tend to be more, you could say conservative, or you could say more nervous, depending on how you view it.
And maybe there is another very quick question from the audience from Marco Ortiz, whether you have an idea on the currency composition of these flows.
Hey, thanks. Hi, Marco. This is to be totally honest, this is a weakness of the data that we use, that we really don't know the currency composition of the flows. What we do explore in the paper, what we do know is, for example, if the fund only invests in dollar-denominated bonds, that's a category of fund that we have, and we do find some interesting heterogeneity along that dimension.
All right, given the time, I think we can move to the second presentation. So thank you very much, Nathan, for your presentation, and thanks for the questions. The next presentation is going to be by Sergio de Ferra, Avoiding Sovereign Defaults, Contagion, and Normative Analysis. Okay, Sergio, I can see your slides already, so floor is yours. You've got 25 minutes.
Thank you very much, Ambrogio, and thank you very much to all the other participants for being here. It's nice to see many familiar faces. So the usual disclaimer applies, since one of the co-authors in this project is Enrico, who was also a co-author on the other project. So he's the thought leader of the whole session, I would say, and so also the responsibility is all his. Okay, so for this paper, we are motivated by the fact that it's often the case that turbulences in the markets for sovereign debt happen in waves. So there's problems in one country, and about at the same time or shortly thereafter, there are issues in other countries as well, similar countries, whether geographically or from an economic point of view. A particular example that motivates our work is the one of the euro area, where we observe troubles in the sovereign debt market, first in Greece, as is well known, and Ireland, and later on to other countries, in particular Portugal, Spain, and a very large country like Italy. So in light of these facts, our research question is whether what should countries do in light of this phenomenon, and in particular whether countries should come together and coordinate to manage this possible contagion that appears to take place across countries in times of high default risk, and so which is costly from a welfare point of view. So perhaps countries' coordination can avoid welfare losses and be beneficial for the households that reside in these countries. So in particular, what we do in the paper is we develop a model. So this is a largely theoretical but quantitative paper, which complements, I would say, nicely the paper that's empirical that you just saw. Our model is a model of sovereign default, which has the peculiarity that it's a two-country model, where cross-country spillovers can occur due to the fact that both of these countries are borrowers who borrow from the same lender. And we calibrate this model to the periphery of the euro area, which is a setting that we are mostly interested in. And given this framework that we build, we study whether there is a possibility of gains from cross-country arrangements that can improve welfare of the resident of borrowing countries. And what do we mean when thinking about this cross-country arrangement? Well, we think largely about two sets of policies. One is a policy that can be characterized as ex post, which is a bailout. That is, a country is about to default, they're having a really hard time, and the other country says, no, wait, don't default. This is going to be very bad for all of us. I'm going to help you and send you a check so that you do not default. Instead, than this ex post policy, you can consider other ex-ante policies, such as, for example, delegation of borrowing decisions to some international planner that decides for all of them. So this is a very extreme form. But we also consider a less extreme form of delegation in the form of Pigouvian taxation. You can think of this as being fiscal rules at the level of the union of these countries, something similar to what we observe in the euro area or in the European Union, which we show can basically decentralize the allocation that the international planner would choose. So the two things are basically the same. So you can think just about the distinction between ex post and ex-ante policies. So let me give you a spoiler, so an outline of our key results. Ex post policies turn out to be counterproductive. And the reason is that bailouts can mitigate contagion, so they may appear as beneficial, because if you bail out a country when it's about to default, you can avoid default. Default is a costly event, so this can be good. But this can only work if the bailout is not anticipated by agents. If agents understand that when the times are hard and they're about to default, they are going to be bailed out, then they will take this into account when making decisions, and so this will result in overborrowing. So countries will end up with a higher debt when they anticipate that they may be bailed out in the event of a default crisis. And this higher debt is not desirable, it's bad. And so actually the default probability does not decrease very much. So summing up, under ex-post policies, welfare may actually go down than under a laissez-faire situation where countries do not coordinate. Instead, what we find is that ex-ante policy may be much more effective because they attack the key issue of the problem, which is the presence of this pecuniary externality of this overborrowing. So when there is a central planner that decides borrowing, the result is lower debt issuance. And as a result of the lower debt issuance, also we find lower default rates. And because of this combined effect of these two forces, we also find that borrowing countries enjoy a higher level of wealth. So our results seem to point out that ex-ante policies, if implementable, are more desirable than bailouts that take place ex-post. So let me give you a bit more background on what motivates our research question. So here is just a picture showing you spreads in the euro area in basis points. As you are all very well aware, spreads have increased simultaneously during the euro area crisis with the cost of borrowing going up at the same time throughout the periphery. So here just Italy, Spain, and Portugal. In addition, what we find is that studying the correlation of output and borrowing costs for these countries, we find that of course these countries are similar, so the processes for output are correlated across countries. It's not that when Spain has a recession, Italy has a boom, rather the contrary. But what we also find is that spreads are extremely correlated as well. And although this is not a conclusive proof, we also find that the correlation of the spread is substantially higher than that of output. So of course we think that there can be common shocks hitting these countries, but we also think that a large fraction of the movement of the spreads is driven by an active contagion across the two. We're not the only ones to say that, although the previous paper seemed to say something that contagion is there is not huge evidence about this. There is evidence about contagion in the euro area, and I will defer to Enrico questions about the merging of this. My understanding is that there is evidence of contagion, but about the specifics, I will let Nathan and Enrico say more. I'm not a super expert on the data, not as much as them. So let's moving forward. I'll be very brief on the literature. So we talked to the literature on sovereign default. There's other papers that already emphasize this channel of contagion through a common lender, including paper by Cristina Arellano, Sandra Lizarazo, and Jan Bai. Ottonella and Perez also have a paper. Of course, we're related to the previous paper we just saw by Enrico and Nathan. And other papers more specifically about the euro area on which I have worked myself, and as well as work by Marina Zimonti and Vincenzo Quadrini about the normative desirability of bailout in a setting of such a setting of tightly integrated countries. So without further ado, let's move on to the model. I will try to be as informal as possible in the interest of time and given the limited attention you might have. So what is our model? As I told you, is a two-country economy. It's an endowment economy, so output is exogenous. There are two borrowers, which are we call outskirt and periphery. So we welcome suggestions for better names. These are the two borrowers. When we say two country, we mean that there's two borrowers. There's actually also a third country, which is the lender, right? And the peculiarity is that the lender is common to both borrowers, and differently than in the baseline sovereign default model, the lender is risk averse. This is going to be crucial for the second bullet point, which is the contagion. The price of the bonds issued by the governments of outskirt and periphery depend on the stochastic discount factor, which is called SDF, which I like, as well as on country-specific default risk. So in the baseline default model, where the lender is risk neutral, all the probability of default matters, but now you also care about the path of consumption of the lender because of its risk aversion. So given the fact that the lender matters, default and borrowing decision in one country affect the lender's wealth, affect the lender's consumption, affect the lender's future consumption, and therefore the lender's pricing of risk. So the decisions that one country takes affect the other country through its implications for consumption and wealth of the lender. So this is the reason why there is this externality and there are these cross-country spillovers. In light of this model, So in light of this model, what we explore are mainly normative questions, so questions of policy. So what we compare is a scenario that we could call laissez-faire, where the two countries, the outskirt and the periphery, decide independently, as they do in a standard sovereign default model. And we compare this setting with one instead where there are international arrangements, such as, for example, the ex-post ones, the bailouts that we've talked about, or the ex-ante arrangements, such as the decisions taken by a central planner or pecuniary taxation. So that's the overview of the model. Let me give you some details. So we could be thinking one of the key ingredients of the model is the role played by the international lenders, which play the role of demanding bonds issued by the borrowers. So the lender receives in each period a constant income, YX, which is an endowment, as well as the payments from the maturing bonds that the lender owns. And also the lender can buy or sell these bonds. So the lender is an agent that maximizes their utility, so they buy and sell bonds to maximize their lifetime utility from consumption. So here what you can see is a key equation of the model. I don't know if you can see my mouse pointer. So here what we show is the price of debt of a generic country I, so QI. Q is, as usual, the price of debt of country I. What does this price of debt depend on? Well, the price of debt depends on the probability of repayment. This is standard in the default literature. And it depends on the SDF, on the stochastic discount factor of the lender, which depends on the lender's current marginality of consumption and the expected marginality of consumption in the future. So in a model where the lender is risk neutral, this is just beta. Instead, here there is these marginal utilities that show up, and so this implies fluctuations in the price of debt. In addition, what also shows up when the lender is risk averse, as you know, as in any asset pricing equation, you also have a term capturing the covariance between risk, so between the probability of repayment, and the future marginal utility of consumption of the lender, which again is another channel through which contagion may happen because of fluctuations in the risk premium. Differently than the lender, the supply of bonds is largely standard. So these are individual countries that face a sovereign default problem, which is common to the one that we observe in the literature on sovereign default. So these are governments that maximize welfare of the residents that live in their country. And the choices that these governments take are two. One is the choice to default or to repay debt. So this is an endogenous decision taken by an optimizing agent. And the second choice is how much debt to issue if the government enjoys access to financial market. We know that governments lose access to financial markets if they default. In fact, the cost of default is twofold. First, if you're in default, you observe an exogenous reduction in output. And second, as I just said, the country that has defaulted on debt suffers from a temporary exclusion from financial market, which makes it unable to borrow, subject to some positive probability of re-entry. What is crucial here is that imagine that I'm a particular country, say the outskirt. For me, it also matters whether the other country, the periphery, has access to financial market and condition having access, how much they are borrowing. Why is that the case? Because whatever the other country is doing affects consumption of the lender and therefore affects the lender desire to buy debt and so the pricing of debt that the lender offers me. And so moving on to the quantitative analysis of the positive properties of this model. So what do? We calibrate this model to the periphery of the euro area. So we divide the periphery into two groups of countries. One, which is the merger of Greece, Portugal, and Spain, which is the actual periphery. And the other is Italy, which we call outskirt. I hope that's not confusing. It's basically like the bigger country, it's the safer country that is affected by this group of smaller countries that are perhaps a little bit more risky. I will not give you the full details on the calibration, but let me just highlight the key elements of what we do. We calibrate the output processes of these countries in the model to match the key moments of this country's business cycle, as well as the relative size of these two groups of countries. Of course, here the relative size matters to determine the extent of the contagion that can happen, right? If one country is very, very small, it has little effect on the lender and therefore little effect on the other countries. We capture the severity of the default cost in the model to capture the average debt to GDP ratio and the average spread over the risk-free interest rate that these countries pay on their borrowing. And then we calibrate the discount factor of the lender to capture the average risk-free interest rate in the euro area, so the interest rate on the German government debt. So let me highlight how this contagion takes place. So here on the left panel, you see graphically the price of debt of the outskirt. In blue, if both countries have access to international financial market, and in red instead is the price of outskirts debt if periphery has defaulted on its debt and it is in autarky. So what you observe is basically a shift down of the curve. So what this means is that from the point of view of outskirt, if periphery is in default, this is bad, because if periphery is in default, the lender has a lower stochastic discount factor, and so is less willing to purchase debt issued by outskirt, or is willing to purchase his debt at worse terms. So from the point of view of outskirt, it's bad if periphery is in default, because the cost of borrowing is higher. The price of debt is lower, means that the cost of borrowing is higher. In addition, what we see is that whether periphery is in default or is enjoys access to financial market also affects the desirability of default by outskirt. So the black shaded area is the area where it is always optimal for outskirt to default. The white shaded area is where outskirt never defaults. But you see there is a gray shaded area, which is the area where outskirt defaults only if periphery also defaults. So here we observe in the model that there is this contagion. So periphery defaults. As a consequence, the terms of borrowing deteriorate for outskirt. Staying in financial markets become less desirable, and therefore outskirt defaults as well, while it would not have defaulted if periphery had stayed in the market. So there is contagion both for borrowing and for default. Further on the economic dynamics, I think I have to go quick on this, but what we observe is that the model captures well moments that are not targeted. In particular, the default rate of the two countries is not that far off from the data. We also spend some time figuring out what is the magnitude of the spillovers in our model to check if it's in line with the data. It is our understanding that it is. In particular, in the absence of the spillovers, the spread would be about 40% lower than they are when the spillovers are considered. So this magnitude of contagion is about in line with the papers on the euro area that we cited in the literature review. So I think, believing that our model captures more or less correctly the nature of the economics of the euro area in this particular dimension of debt issuance and contagion, let us now move on to what is our key area of analysis, which is these normative aspects. So what do? How we study how can countries coordinate among each other to improve their welfare and reduce the magnitude of undesirable spillover in the market for sovereign debt. And as we said, we focus on two types of policies: ex post, so bailouts, and ex-ante policy, so coordination by a planner or epicuvian taxation. So first of all, let's think about the implications of unanticipated bailouts. So bailouts that come as a surprise. So let us clarify how we do this in the model. In the model, the timing of events is as follows. First of all, the governments observe the states of nature, so basically the realization of the endowment and their debt. And given this observation, they decide how much they want to borrow and whether or not they want to default. However, here's where the unanticipated bailout shows up. Before they actually take their action, these governments learn that there is this possibility to send transfer to the other countries and to bail them out. So these bailouts, the possibility of bailouts comes as a surprise. And in particular, there is this possibility of bailouts, but countries are not allowed to change their borrowing decisions given this realization. However, what they can change is their decision to default. So they can say, I wanted to default, but since you're bailing me out, I don't do that. And one aspect to point out is that these bailouts are only implemented if they're mutually beneficial. No country here is forced to bail out another country that they don't want to, which may be relevant, but it's not what we focus on. So country I bails out country J only if country I wants to do that, if they understand that they have benefits from this. And country J is not forced to repay debt. They receive the transfer and say, okay, since you give me the transfer, I repay, but they're not forced to repay debt. So we think that this captures an important dimension of the euro area, although there are discussions whether these bailout transfers and this default repay or this debt repayment were entirely voluntary. So what we observe is that there is an area, which is the area shaded in red, so it's there of the state space. So on the x-axis you have debt, on the y-axis you have output, where, so here what do we have? In the black area is where periphery wants to default. In the red area, instead, what we observe is that periphery would default. However, if periphery receives a positive transfer from the other country, from outskirt, and then the magnitude of this transfer will vary, then they will repay. So here in the red area, periphery may default or may repay depending on whether the other country chooses to issue with the transfer. So there is a positive subset of the state space where these bailouts may happen and they're mutually beneficial to both countries, and they switch the default decision by other country, here in this case of the periphery. So bailouts emerge in equilibrium in this model economy. So just to give you an idea of what are the economic dynamics here, so we consider a transfer from outskirt to the periphery that takes place at time 0. So this is just to point out when the transfer happens. And what do we observe is that in the absence of transfer is the blue solid line, the debt by outskirt would fall to 0. So here periphery sends the transfers to outskirt. So the debt will fall to 0. Why? Because periphery will default. If periphery does not receive the transfer, it defaults. If instead periphery receives the transfer, it does not default and it repays debt. Still, debt falls. Why? Because this amount of debt was very large. So outskirt receives the transfer and says, okay, I do not default, but this debt that I have is very large, so I will cut it down significantly. And then later on, this debt goes back towards its ergodic level, right? And this also takes place, the debt also increases even after default because with some probability the country is readmitted. What we observe is that for consumption, if the transfer does not take place, so in both cases, consumption falls, but consumption falls by more if the transfer takes place because the country receives the transfer but still chooses not to default it and it contracts its debt massively. So consumption is initially lower for the country that receives the bailout, but it's higher later on, while instead consumption remains low for the country that defaults and suffers the default costs. So this is just to give you an idea about what's happening in these two countries when default or transfers take place. Summarizing more completely what happens to the model economy, we find that when unanticipated bailouts are implemented, countries' debt issuance is not affected. Right? On average, their debt levels are the same as in the laissez-faire economy. And this happens by construction because given the setup of the policy, countries cannot change their borrowing decisions upon bailouts. However, what we also observe is that on average, default rates fall. Why? Well, because that's exactly the point of the bailout policy, right? When there are bailouts, countries that would have defaulted do not default. So on average, the number of defaults go down. And as a consequence of this fact, welfare rises for both borrowers as well as for the lender. And the reason is that defaults are costly events, right? They force you out of financial markets and they impose direct output costs. So if bailouts can avoid them, these lead to increases in welfare. In addition, the lenders also gain because they do not suffer losses on their assets, so their consumption also goes up. And moreover, when the bailouts are unanticipated, they don't have unintended consequences, so there is nothing wrong coming from them. We believe, however, that these unanticipated bailouts are not fully realistic, so we now consider the case where the bailouts may be anticipated by the borrowing countries. So now, suppose that governments and lenders know that bailouts are possible. So now what is going to happen is that governments are going to modify their borrowing behavior in the expectation of bailouts. And now the results that we find quantitatively, you can find the details in the paper, I will not bother you with all the numbers, is that their behavior does change substantially. And in particular, what we observe is overborrowing. So when a country knows that in the event of trouble, it's going to be bailed out, ex-ante, they will react by borrowing more because they know that having high debt is not so bad, because if I have high debt and if I'm about to default, somebody's going to bail me out. So what we observe in equilibrium is that when there are bailouts, and these are anticipated, that levels are higher. In addition, what we also find is that the default rate does not fall very much, because it is true that bailouts avoid defaults. However, debt levels are higher. So a higher level of debt generates higher, stronger incentive to default. So the default rate falls by much less than with the bailout was unanticipated, and the default rate is just slightly lower than in the laissez-faire economy. Moreover, compared to the economy where bailouts are not anticipated, bailouts are much more frequent because now these countries are accumulating lots of debt and so they need to be bailed out often. And so these are lots of adverse effects. In particular, there is a higher default rate and higher debt levels imply that consumption is lower for both borrowers. And so overall, the effect for welfare is negative. The lenders are still better off because the lenders still enjoy the fact that there is all this debt that they can buy, which allows them to smooth their consumption. In addition, even if this debt is risky, it is bailed out often, and so that's not so bad. So the welfare of the lender actually goes up, but the welfare of the borrower is lower when the bailouts are anticipated than not just the unanticipated bailout economy, but also relative to the laissez-faire economy. So this type of ex post policy is very undesirable. So let's see if countries can do better. So if these countries can come together and write down a contract where they delegate their borrowing decision to a central planner, maybe the outcome can be better. So in particular, let's think that there is this central planner whose objective is to maximize the sum of welfare of the two countries and choose how much to borrow accordingly. And let's consider the setting where when we don't let this planner choose the default. We let the default decisions to the two countries.
Sergio, you have about a minute.
Yeah, okay, I'm going to conclude. So when this happens, this planner internalizes the adverse externality that excessive borrowing causes. And if you see a dashed line, it's how much debt the planner chooses. And for both countries, the planner chooses lower issuances of debt, right? Because the planner understands that too much debt is detrimental. So the outcome of this economy, the central planner, is that borrowing is lower because the planner understands the negative externality. And as a consequence, there are also fewer defaults and lower spreads, not because the planner forces them not to default, but because it forces them to issue less debt, and therefore the default incentives are lower. And as a consequence of this, welfare is higher in the outskirts and in the periphery, because this adverse externality is corrected. I will not say too much on Pigouvian taxes in the interest of time, just saying that through Pigouvian taxation, if appropriately designed in a complicated way, you can replicate the planner's allocation. So coming to a conclusion, we review a set of policies that we think are interesting in a setting like that of the euro era, where we observe the presence of spillovers and contagion in sovereign debt market. But we find that these policies are not all equal, they're not all interchangeable. In particular, we find that ex post policy can have severe detrimental effect when agents understand that they are in place because they lead to overborrowing. On the other hand, if ex-ante policies can be implemented and if these are designed in the correct way, and if that's possible, then we find that these ex-ante policies have the potential to correct an undesirable externality and lead to higher welfare for the residents of the EU. So that's it for me. Thank you very much.
Thank you very much, Sergio. We have a few minutes for questions from the audience or the panelists. Sergio, while people might think of questions, I have a very quick one on the modeling choice of having an endowment economy rather than a production economy. And I'm just drawing a parallel here with the overborrowing literature on the consumer side, where if I remember correctly, you have different results on the desirability of ex post relative to ex-ante policies, depending on whether you consider a production economy or an endowment economy. Is this something that concerns you at all? You know, or in other words, you know, how important is the assumption of having an endowment economy here?
Okay, that's a very nice question. So let me first of all give a lame answer, which is that the model is extremely difficult to solve as things stand. So from a technical point of view, it might be very difficult to do a production economy. It can be done in a simple way that replicates closely endowment economy, so perhaps not very interesting. I think your question is a very interesting one. Like, you could think that when countries have a lot of debt, there's some wealth effect that kicks in that makes people work more. So this could have endogenous implications on output. So the effects may be slightly different and perhaps more interesting. We haven't thought too much about that, but it's a very good point. So I think at the moment there is like sufficient action going on that I think the endowment economy has got many things that are ready, many moving parts. So, but yeah, you're right that having endogenous production can have interesting implications. We're not super concerned, but I think that's very interesting. My question is how feasible that is to do that in a way that's manageable, not just technically, but also like managing the entire set of results. But yeah, it's a good point.
So sorry, I'm gonna step in. I'm gonna say that my feeling is that with the production economy, so the introduction of the production economy is gonna matter for the size of that. I doubt that is gonna matter so much for the size of the spillover between the two countries, because the key ingredient here is really the spillover between the two countries. So I think it will affect the level. It might affect the magnitudes, but like the same kind of contagion mechanism should go through. That's my feeling.
Thank you, Enrico. That makes sense, I guess. All right, we are slightly over time, so thank you both for your contribution to the session, and we're going to move to the third paper in our session, which is called Cross-Country Co-Movements in Sovereign Bond Markets, Accounting for the Fundamental and Information. And the presenter is going to be Paula Margaretic. I can see already the slides. So Paula, I leave the floors to you.
Thank you very much. Thank you very much. So the paper I'm going to present is Disentangling Empirically the Informational Channel of Economic Interdependence Between Countries. This is joint work with Alejandro Bernales from University of Chile and David Moreno from the Central Bank of Chile. So let's start with a short motivation of why we've started working on this project. So as you know, globalization has provided us with enormous economic benefits to all of us, let's say for developing countries like economic growth, for advanced economies, lower prices, but at the same time it has increased the interdependence between countries, and the side effect of it is that there is a higher transmission of crises between countries. The literature has identified three main channels for the propagation of shocks across countries. The first one is what we call the real linkages, basically, for instance, due to trade, countries trading between themselves, and this is one way of shocks being transmitted across countries. The second one is the financial linkages, for instance, because of common investors, as we've seen before in the sessions, or the third one, which is based on informational linkages. And this informational channel of interdependence, it emerges when investors have a fear that there will be a crisis in a given country after observing a crisis in another country, which appears to be similar to the first country, where such a fear is due to frictions somehow in the learning process of investors. Think of this as incomplete information and or some kind of biases, cognitive bias, informational bias. So the important thing here is that crises due to this channel can be transmitted even between countries that are not fundamentally linked through real and financial and/or financial links. And while this is important, or it seems to be important, there have been a few only empirical studies examining or quantifying the relative contribution of these channels. The reason for that is basically that the informational link or the informational channel is difficult to measure empirically, as it depends on the learning processes that investors follow under information sets, and these information sets we typically don't observe. So what we do in this paper, we try to analyze empirically this information interdependence channel between countries, accounting at the same time for the real and the financial channels. And to account for this informational channel, we are going to propose a simple proxy that I'm going to detail in just a couple of seconds for these linkages that tries to capture the frictions in the investor's cognitive process, which in the end are responsible for these informational linkages. And then we are going to quantify the relative contribution or the relative importance of this informational interdependence channel relative to the other channels of co-movements. So let me say a few more words about this informational linkage or informational channel, because it's the main ingredient of this paper. So the way we proceed is we proceed in 3 steps. So first, we are going to proxy for the information sets of agents with the monthly evolution of the cross-sectional dispersion of GDP forecast. So basically, for each country and each month, we have access to the cross-section of analysts 1 year ahead GDP forecast. With this cross-section of analyst forecast, then we are going to compute the standard deviation of this GDP forecast, and then we are going to have this evolution, this monthly evolution of these standard deviations. And these standard deviations will be our proxies for estimation errors. Then we are going, a second step, we are going to calculate the correlations between the pairwise correlations between investors' estimation errors between countries, and these correlations will be will be our informational links between countries. And in the last step, we are going to say for each pair of country, how strong are these correlations? If you want, think of this as like looking at how statistically significant are these correlations, and based on that we are going to say whether two countries are informationally linked or not. And then we are going to integrate this informational channel together with the real and the financial channel, and we are going to, thanks to the spatial econometrics literature, we are going to evaluate and quantify the relative contribution of each of these channels. But the important thing I want to say about these slides is basically that somehow the estimation errors are a consequence of the cognitive mechanisms that investors face. And this way, the fact that we are analyzing the evolution of these errors through time is basically we are trying to analyze the behavior of these informational frictions or cognitive frictions, which in the end are responsible for these informational linkages. So now that I've presented our proxy, what we do is we try to evaluate the relative importance of each of these channels. As I said before, we look at or we rely on the spatial econometrics literature to do so. This is another important thing that I want you to pay attention on. For each of these channels, we are going to build one interdependence matrix. Okay, each entry in one of these metrics will correspond to a pair of countries and will indicate whether and to what extent these two countries are linked to each other in real financial or informational terms. So one matrix for each of the linkages, and one entry in one of each of the matrices will say whether the pair of countries are linked or not. And to be short, the intuition that you would have to say is, well, to say that two countries are connected, basically we are going to look at a mean value of the linkage measure that we consider, and we are going to say that when this measure is sufficiently strong, we say that these countries are connected. When it is not sufficiently strong, we say that these two countries are not connected. To summarize, what are the main results we obtain? Well, basically, we show that the strongest channel of interdependence is the financial channel, followed by the real and the informational channels. One interesting finding that we show is that basically how important are the sources of the economic transmissions vary over time, which means that the informational interdependence channel is the importance of this channel is lower in the crisis period relative to the post-crisis period. When we talk about the crisis periods, I'm referring to the period started at end of 2008 up to April 2013. The post-crisis period for us will be the period starting in May 2013 until end of 2019. And conversely, we show that the financial and the real channels are stronger in the crisis period than in the normal times. One way to rationalize these findings of the changes in the importance in the three sources of economic transmission is that this might be because there is a change in investors' perception of the benefits of additional information production during crisis and normal time. Think of this, for example, during crisis time, investors may have more incentives to produce more information to better understand the uncertain times they are facing. And so when they do so, they purchase more information, they become more informed. So they are more informed about the real and the financial linkages between countries, which is consistent with the real and financial linkages becoming stronger over those periods, and in detriment of the informational channel, which is more related with an illusory linkage between countries, maybe. And we also find evidence of investor thinking in terms of groups of countries. There is a literature that calls it like category thinking, which means higher informational linkage, for example, between advanced and between emerging economies. So in the sake of time, I'm going to skip the literature review. And I'm going to now say a few words more about the methodology. I'm not going to enter into the details. If you need, we can answer some questions later. So this is basically the specification without interdependence. On the left-hand side, we have CDS spreads, which will be our dependent variable. We will have some macro variables, standard macro variables. We allow for common factors, let's say, sorry. We have country and time fixed effects. And that's our addition to the model specification with interdependence. So WP corresponds to one of the three matrices of interdependence, with P being the subindex for R, F, and I, corresponding to the real, the financial, and the informational channels of interdependence. Okay, so basically what we are saying here, if we have a country Y, a country I, let's say on the left-hand side, basically what we are having here is basically the countries that are real, financially, or informational linked to country I, okay, according to one of those matrices. One important thing to say is that the diagonal elements in any of these matrices are 0, meaning that a country cannot be linked to itself, okay? Now, I'm going to go quickly on the way we compute the linkages. For the real linkages and the real metrics, we are going to compute a trade intensity measure, looking at the bilateral trade data. We are going to average it across time, scale it by the standard deviation, and then the idea is that to find the zeros and the non-zero values of this WR matrix, we are going to say whenever this trade intensity measure is sufficiently strong in a statistical sense, we say that the two countries are linked in real terms, otherwise it takes a 0 value. For the financial connectedness matrices, we are going to look at the data on assets under management of APFR data set. We rely on the results of Bronner and co-authors 2006. Basically, what they propose in that paper is a measure of the reliance on a country I on investors overexposed to country J. So basically, again, we have this bilateral influence or overexposure of two countries. So we are going to use that measure to say how related in financial terms might be two given countries. We're going to average across time, scale it by standard deviation, and again, consider that two countries are financially linked whenever this measure is sufficiently strong across time. And for the informational linkages, I've already explained a little bit how we're going to do it. But the idea is, again, we have an estimate of the pairwise correlation of the GDP forecast dispersion, and we look at those pairwise correlations that are sufficiently strong in a statistical sense in order to find the zeros and positive values in the corresponding interdependence matrix for the informational linkages. Once we have these the estimates for each of the informational matrices, we can estimate our model. We've controlled for, I'm not going to enter into the details, but we control for cross-sectional dependence and possible sources of endogeneity. One thing which is important though is that to avoid any endogeneity due to simultaneously the interdependence matrices, we build them or we estimate them considering a period previous to the estimation period. This is to avoid any endogeneity bias. And the period that we consider for building the interdependencies matrices is 2000-2007. Regarding the dependent variable, we have data on CDS spread, 5-year CDS spreads. We consider a sample of 32 countries, of which 14 are advanced and 18 are emerging over the period, as I said before, 2008-2019. Here you have the control variables that we use. We have inflation, we have GDP, fiscal balance, among others. All the variables are lagged one period, which will be one quarter or 1 year, depending on the frequency of the data. And here we go, we start with the results. So what you have here is basically the variables, the control variables that we have. And the 3 rows that appear here corresponds to the estimates for the 3 matrices of interdependence: the real, the financial, and the informational channel, okay? In the first 2 columns of results, I have the estimates when only including the real interdependence matrix. The 3rd and the 4th corresponds to the estimates only including the financial, and the 5th and 6th only corresponds to the estimates only including the informational channel. And the last 2 columns correspond to the estimates when including the 3 sources together, okay? And the t-stats, they are always accompanying the coefficient estimates. What we observe when we look at the last two columns is basically that the 3 channels are significant and positive, that the financial channel is the most important, followed, at least in the full sample, followed by the real and the informational channels, okay? The interpretation of a positive parameter estimate means that a negative shock to a country I not only affects the country itself, but also the countries to which that country is linked according to a given matrix of interdependence. Now, what we've done, the first question we've asked was to see whether this this interdependence or the importance of these interdependence channels change through time. That's how we split the estimates for the crisis and the post-crisis period. Remember that the crisis period was the estimates up to April 2013, and the post-crisis period was from May 2013 until the end of our estimates, which is 2019, end of 2019. The full sample was already the estimates that we've seen in the previous slides. And there are a couple of interesting things that appear. The first, I would say the first main finding from this table is basically when we compare the column crisis and post-crisis periods, we observe that the real and financial channels are more important during the crisis period. If you compare the crisis and the post-crisis period, whereas the informational channel, it is less important in the crisis period and more important in the post-crisis period. As I said in the preview of the results, our way of interpreting these results is basically, we think it in terms of Ordóñez and Gozo's papers, where they talk about the benefits of acquiring information during crisis and normal times. In crisis periods, we want to be more informed and the marginal benefits of acquiring more information are higher because you want to investors want to better understand their uncertain environment. So this would result in investors better knowing how countries are fundamentally linked in real and financial terms, which is consistent with the parameters being higher for those channels over that time. Whereas in detriment of the informational channels, and whereas in the post-crisis periods, maybe the benefits of acquiring more information reduce incentive, investors have less incentives to acquire more information, and this may result in investors behaving or treating countries like as more in groups, thinking of them in groups of countries, and this would this would be consistent with a higher informational interdependence in the post-crisis period. In order to have a better to better assess this idea of investors behaving in terms of categories or category thinking, what we've done was to decompose this informational channel, allowing for specific coefficients for the country pairs involving only emerging economies, advanced economies, or advanced and emerging economies. So what we exploit somehow, we partition our informational metrics, and we have now one informational parameter for subgroups of countries. Again, this is the informational parameter for the country pairs involving 2 emerging economies. This involves 2 advanced economies, and this involves 1 emerging and 1 advanced economy. When we look at the full sample period, what we observe is that informational interdependence is higher between countries which are more similar, notably between advanced economies and between emerging economies. And what we find is that in the case of informational interdependence between advanced and emerging economies is not significant. However, this last point may be due to the fact that actually there are differences. This is an average of differences across time. So we went one step further and we split by sub-periods, again, crisis and post-crisis periods. There are many things to say about this slide, but let me highlight a couple of things. So the first thing, when we compare crisis and post-crisis periods, again, we confirm that the real and financial channels are more important during the crisis periods relative to the post-crisis period. Okay, we see that, for instance, the informational linkages between advanced economies is stronger, and it increases during the post-crisis period. And then you may wonder why we have this negative and significant coefficient in the case of advanced and emerging economies for the crisis period. Our way of, we interpret this finding in the lenses of rational inattention models, like an attention shift, in the sense that during the crisis, during the subprime crisis and the European crisis, investors may have put more attention to advanced economies, which were at the core of the crisis, in detriment of the emerging economies, and this might have resulted in the informational linkages between advanced and emerging economies during that period decreasing. In any case, building a model in order to somehow elucidate each of the parameters is out of the scope of the papers. We use the theoretical literature to interpret our results. So I guess I'm running out of time, so I'm going to just to go quickly on the
Yes, you have about a minute, Paula.
Okay, so just let's say, one technical point to say, and then I would like to say a few words about one of the applications we've done. In this type of spatial autoregressive models, the interpretation of the coefficients of the macro variables in this case as marginals is not possible, and it's not straightforward because you have this co-movement part. So basically what we've done is to compute the marginal effects with a little bit of math. And this is what I'm reporting here, is basically to interpret in a proper way the signs of our estimates. And here what we're distinguishing is the direct and the indirect effects. The way we should read this table is basically suppose a unit change in one of the control variables, let's say GDP. Then because you have these spillovers and these network effects, this change in the GDP of a given country I has a direct effect, and let's say an average direct effect on countries I, and then you have an average effect on all countries J different than I, and this is the indirect effect. And what you observe, and this is what we are reporting here, what you observe is that in the majority of the cases, the indirect effect is larger than the direct effect for almost all of the control variables that we will include here. And let me use the last minutes I have to explain one application we've done, which is the COVID application. So basically what we've done here is we took the IMF projections for end of 2020 for GDP, inflation, and fiscal balance. And we relied also on our model estimates. And based on these two things, we've projected what would be the CDS spreads for the first quarter on 2021. Okay, and this is basically the empirical distribution of the observed CDS and the predicted CDS according to the model and according to the damage predicted by or projected by the IMF. Y hat is basically the CDS predicted by our model for the first quarter of 2021. We distinguish between emerging and advanced economies. I'm not going to enter into the details of this, but basically what this table is saying that the effect of the COVID shock is massive, both in emerging and advanced economies. But what we believe is more interesting is to look at the direct and indirect effects of the shocks to GDP, inflation, and fiscal balance that we've assumed in this exercise. And here we can decompose these direct and indirect effects, distinguishing again between emerging and advanced economies. So to briefly...
Sorry to interrupt you. You're now over time. You should try to wrap up.
Okay, let's just to say that the indirect effects are larger than the direct effects and the GDP, and that's it. Okay, and the main takeaway I would say is that the informational linkages are important, and they're important differ between crisis and normal times and between subgroups of countries. Thank you very much.
Thanks to you, Paula, for the nice presentation. We have maybe time for a very quick question from the audience.
Some comments, questions, perhaps, Ambrogio, if I may.
Please go ahead, Maurizio.
So, first of all, many thanks. Very, very nice presentation. I'm the following speaker, so I can gain time. I will shorten my presentation in order to give some time for the discussion. And basically, I have three issues. The first one that, sincerely, looking at the slide several times on the slide on the definition of the informational linkages, I still don't get it. I don't get what is exactly this informational linkages. Is the dispersion between two countries of the forecast, but this also will be time varying and depending basically on the crisis. The second one is basically both the interpretation of the results of the informational linkages during the crisis and also the definition of crisis. First of all, it would be good to focus more on really volatile periods. So that those that are really volatile, so 2007, 2008 in particular, or other spikes in volatilities, and not just to cut the sample. The second is that actually my understanding, and it's not your interpretation, is that informational rents, I mean my supposition, will be very challenging during crisis periods. So basically, whenever there is a crisis period, the people, they just retrench from portfolios, emerging market as a whole, and they don't really get, because information really needs time. And there are a number of papers in the literature about the fact that the people to get information and to have about their portfolios, they have to invest. So finally, just a very practical issues. Use EPFR 2006 paper. I mean, there are now really a substantial strand of literature showing that one has to pay attention when using this data to get something like cross linkages. I mean, it would be wise to use at least CPIS data portfolio. So from the IMF, these are available. You can create matrices. They are broader. First, because investment funds is only a subset of investors into several countries, may be relevant for emerging markets, but not for advanced economies. And second, for advanced economies, particularly the euro area, other papers also have one paper that they show there is a really large financial center bias. So you will have very biased results. So at least you have to try to fix that and
Maurizio, thank you for the extensive questions. And given the time and the time constraints we have, Paula, may I suggest you pick up one of the questions that you can answer relatively quickly, please?
Yes.
So we can move on to the next presentation, and you can then pick up some of these issues bilaterally, maybe.
Yes, sure. Thank you very much for all your questions. Maybe I can take the first one, which is, we use the time series of these standard deviations, okay? And based on that, we compute the pairwise correlation across time. So from the standard deviations, we are going to compute one value for each pair of countries, which will be the correlation. And then we look at whether this correlation per pair of countries is sufficiently strong. And this will give us a measure of how informationally linked for the period we consider, these any two pairs of countries in our data set are linked. So the evolution of the standard deviation is used to compute our pairwise correlation measure. But maybe we can discuss about all these interesting questions later. Mauricio, thank you very much.
Thank you very much.
That'd be great. Thank you very much.
Thank you.
So, thanks, Paula, and thanks to all the attendees. We're going to now move to the last presentation in this session. Maurizio is going to be the presenter, a joint paper with Fabrizio Venditti and Liva Stracca, The Making of Global Safe Assets.
So this is a paper on safe assets. This is a paper that has been actually quite successful, that in the sense that we presented in a conference, and then has been immediately published in the Journal of International Money Finance. And we didn't have time basically to share it outside, to receive more comments. And this is the reason why we have it here, because we are very much interested in this topic of the fundamental of safe assets. And we would like to receive comments for further work and for the suggestions if there is time. So I will try to be short and to see whether there are questions, suggestions, or comments on the research. So we'll talk about the motivation, our contribution and main findings, a simple empirical model of asset safety, the data, results, and conclusions. So why we talk about safe assets? So there are growing interest in safe assets. We know that safe assets they provide some certain and nominal repayment, even in the worst state of the world. What is important of safe assets is they are information insensitive, especially in bad times. So this was exactly related to the comment that I had before, that in particular in bad times, you don't really care, and then you go straight to something like, I don't know, safe assets, for instance. And we'll see later what could be these safe assets. They have a negative beta, so they appreciate in market downturns, and usually vice versa. Why are they important, safe assets? Safe assets are important because there are some macroeconomic consequences, as mentioned by Caballero and Gourinchas. So we have seen, in particular since the global financial crisis, secular increase in the excess demand for safe assets. And what happens is that, of course, the global safe interest rate, so that one related to safe assets, like for instance, government bonds, drops to zero. Then it reaches the zero lower bound, but then there is still demand. And the natural safe rate, which will clear the market for safe assets, is below zero, but it cannot go below zero. So the actual safe interest rates is above the equilibrium safe interest rates and will generate an excess demand that cannot be cleared by prices, and according to Caballero and Grinchas, this can be cleared only through a recession, basically. So with the quantities and with consequences for the real economy. But our understanding of what makes a safe assets is really limited. What we know that is important is that is an element of coordination of investors, and the fact that the size of the market that you want to acquire is relatively large, so there is something like nowhere else to go. And Brunner used two analogies. One is the good friend analogy, something like the one that also we use, is that a good friend is there when you need it. That is a good friend. And then is the safe asset, is that when everything, basically all the prices are collapsing, going down, the asset instead is keeping its value or even increasing its value. And there is also a tautology, meaning what is the safe asset tautology? Is that what it means is here is that what everybody believes that is a safe asset. So there is an element of coordination of investors, and everybody thinks that gold is a safe asset. You don't know why. I mean, why gold? I mean, it's also only because it's shining, but everybody buys gold when there is a crisis. So we focus on, of course, on asset prices, not on gold. Then we know there is a lot of research on the characteristics of US treasuries. So there is a lot of analysis, and there is some analysis on US treasuries. The safety attribute of beyond liquidity, Krishnamurti and Vincent Jorgensen. And but only really sparse empirical evidence across different countries. So there is only this one paper by you and others that they show that there is a secular decline in the convenience yield. So the premium that you pay to acquire, for instance, US treasuries, or at least one securities having the same characteristics, credit characteristics above the other. And that is convenience basically has been declining for long-term US treasuries and is positive only for short-term maturities. So for US treasury bills, not bonds. What is our contribution? So we talk about safe government bonds that we think that they appreciate, and then we look basically and the yields decline when global risk aversion rises. So, and that is measured by line increases in the VIX. So basically this is similar to the good friend analogy of Brunner-Meyer. We have the global focus. So this is the main contribution compared to many other studies, that we don't look only at the US, for instance, or just a few countries, but we have a global focus and we look at long-term government bond yields, cross-section, 40 economies since 1990. We deepen our understanding of the role of fundamentals. So we want to check whether there are some fundamentals that are associated with those safe assets in periods of financial turbulence, something specific on the special role of the US. And finally, this is something that we do in this analysis, but I will not show here for reasons of space. We will also look at the fact whether this protection is conditional of the source of financial turbulence. Disentangling different drivers of global risk aversion, US monetary policy, financial and geopolitical risk shocks. This is based on another study with me and Fabrizio Venditti and the global financial cycle. There are some background slides then that can be shared with the audience to look at this particular aspect. What are our main findings? We find that only a handful of variables explain why some government bonds behave like safe assets in periods of high risk aversion. These are inertia. So basically whether bonds in certain countries behaved as safe asset in the past. And this explanation lends some support to the tautology of Brunner-Meyer, so the fact that there is an element of a bubble-like element that everybody thinks that this is good, and then everybody buys this asset in period of risk aversion, and then they think this is a safe asset. Then, of course, political risk is important, and then there is a crucial role of the size of the debt market in relative terms, and not only in absolute terms in level as a percent of GDP, but in relative terms, how large is the market compared to other markets. What we find is that the fundamentals are different between advanced and emerging economies, and also across time. And then we see that the special role of the United States is evident through the size of its debt market or its international role, while we find little influence from the nature of the shock that are driving global risk aversion. The empirical model is rather simple. It's a parallel regression. 40 advanced emerging economies is similar to a paper that we have done with Livio Stracca in 2012 on the fundamentals of safe haven currencies. It's a balance. So the dependent variable is the change in long-term government bond yields. It's standardized by each country's standard deviation, because we know that some emerging markets have a more volatility in bond prices, in yields, compared, for instance, to advanced economies. So the standard deviation is used to make it similar, so that we know there is a similar change across economies, that is not driven by the fact that the data generating process of that specific country for yield for that specific country is different. Then we have a vector of controls of country fundamentals. And then crucially, you can see here underlined in red, is the interaction of these fundamentals with the change in the VIX, or that is in the extension of the analysis, one of the shocks instrument. What we care is this gamma coefficient, is the interaction term. We have a country fixed effects, a time fixed effects, so we don't look at what happens, what is the VIX doing. This is captured by the time fixed effects, but we focus only on the diff and diff in time and across economies for the interaction term. We have a number of control variables, carry trade, we check for the trilemma, for instance, if countries that are open adopting a less flexible exchange rate regime experience a stronger transmission of risk shocks. And crucially, exactly this is the term that is more interesting, is this self-fulfilling prophecy or inertia. Is this term that it is important, is basically the correlation of the change in bond yields in the past with the VIX. So basically, if in the past, when the VIX was going up, your bond yields were going up, we think that this is not a safe haven currency. So the higher it is, the less it should be safe haven currency. So this is basically the sense. It's a rolling correlation, and it's a recursive correlation, so it gets larger and larger through time, but this is basically the set of information until t-1. So, and this is inertia term. Fundamentals, the usual one, and don't go through all of them, but it's GDP growth, inflation, debt, external sustainability, the political risk rating index, and crucially, the size of the market, so the share of world market public debt compared to the whole debt is a share. All fundamentals are annual frequency, are lagged, interpolated and lagged by 12 months to avoid any endogenite or at least any terms. Data summary statistics, here we don't go through them, but it's just simply to point that it's always important to look at your data, see what happens to your data, and then what we see is that with the yield change, even if they are standardized, is that there are large outliers, as you can see from the kurtosis in the box. So not only so we divide it by the standard deviation, but then we Wilsonize the data just to avoid that outliers may drive the results. And these are the key results, more in detail, basically. And then we can see basically in the baseline, we have these the terms that I already mentioned in the summary. Inertia, better risk rating, a large debt market, the size of the market are important. And of course, there are also some traditional fundamentals, like the level of public debt as a share of GDP this time, or the fact that you had strong GDP growth. But you can see, also looking at the table, that these changes across a group of countries. There are advanced economies, the political risk rating is important, or the size of that market. For emerging economies, instead, the inertia is particularly important. And then we have the GDP growth, it used to be a fundamental before the global financial crisis, while since the global financial crisis, at least the external sustainability appears more important. And then I will talk later about the US. So these results are indicators. You see how basically just to show how we operate. Basically, these are only showing the interaction terms basically, and not all the other controls that are entered. And just to see, for instance, that the level of the yield is the carry trade. That is always important. But then when controlling for other factor disappears, and then in yellow you see the fundamentals that they always remain significant, and they enter with basically with the right sign. For instance, the inertia, the correlation in the past is positive. So if you add a positive correlation with the yields in the past, of yields with the VIX in the past, then it is again significant to explain the cross-country variation of yields at time t. And then you have growth, of course, the stronger growth instead would lead to lower bond yields when volatility increases. Same with debt, which is in this case debt as a percent of GDP. And the political risk rating instead is an index which improves when it gets higher, and then for this reason the coefficient is negative. And size again is what you would expect. The larger your debt market compared to other market, so the more liquid, expected to be more deep and liquid your market, the more your yields will decline when there is an increase in volatility. Interesting exactly is to see across countries, also across time. And these are basically the details of the results. You see that basically in the full sample, the first three columns, inertia, risk rating, and size are always significant, also across subsample. But if you disentangle them, advanced and emerging economies, you find that some of these coefficients may become not significant in some subsamples. Then, of course, one has to think that the investors, they may differentiate, for instance, in the full sample among advanced and emerging economies according to one fundamental. But for instance, for advanced economies, the current account is not usually a major issue, that you have a flexible exchange rates, but it may become an issue. For instance, the size of the external of the current account among emerging markets, and this you see in fact that this is significant with the right sign basically. For emerging markets. So it is important to see basically what kind of country sample you're looking, how you're comparing across countries, and also the time variation through time. And then basically this here is to make basically some economic significance of our results. This is a different approach. So we can look only what happens compared to another economy, and we don't have the complete size because we don't estimate the VIX itself because we have time fixed effects. But we can see a different and in particular we can see the difference between the changing yields between some group of economies, and then we take, for instance, compared to the US. So let's take a large shock, for instance, 2 standard deviation shock for the VIX. And then what I do, I look basically what are the months that we had these shocks, and we identify around 10 episodes. And then I take the average of the changing yields for a group of countries, and then I say, okay, this is what happens really to yields in this group of countries. 3 group of countries. Other safe haven, so there are basically UK, Japan, Switzerland, and so on. And Germany, of course, and then we take other advanced economies and then emerging economies. Then what you see on the vertical axis is the change in yields compared to the US. So the diamonds, the black diamond is what really actually happens to yields in these large shock episodes. And you see that basically for other safe haven, there is basically no difference with the US. For other advanced economies, they have a slightly higher yields, changing yields compared to the US, and of course larger for emerging markets. And then instead the bars show what is predicted. Of course, we take only one level of the fundamentals, and then we take the fundamentals in 2018. But then we multiply by the gamma that we found, and then we plot them and see what would be predicted by our model, taking the fundamentals in 2018. And then you see that what is really matters is basically the size, the relative size of the debt market, and political risk rating, in particular for emerging economies. That means that the political risk rating explains a lot of difference between emerging economies and advanced economies. That doesn't have to be the fact that the political risk rating is a significant coefficient across emerging markets. And then the terms inertia is also particularly important for emerging markets. Finally, a few words on the special role of the US. We have been asked to say, okay, but what is really peculiar about the United States? And then we try to enter other control variables in the regression, and you would see what happened with the US. So we have a dummy for the US, a dummy for other safe haven economies, again, which is, for instance, Germany, Japan, Switzerland, and United Kingdom. And then we put these two dummies. And then what we find, then you see in the second column, is that basically the dummy for the US is not significant, it's negative, while the other for other safe economies is significant. But we see that the coefficient for the size of the debt market is not significant anymore. So we see that there is something going on there. Then is what we done, and then we kicked out the size of the debt market, which we know, of course, it is very large for the US, the very large size of the debt market in relative terms compared to other economies. And then we see that now the dummy for the US becomes very large and significant. So that we see that there is some correlation with the size of the debt market and the special role of the US. In the fourth column, we do another exercise. We kick out all the dummies for US and other safe haven. And we include the share of the currencies of each country in international reserves. So the IMF cover data. So the share of the dollar, about 30%, something like that, and so on, of course, as a share of total allocated reserves. And then we see that this is another possible role, the international role of the dollar, that could also explain safe havenness of the US. So overall, there are a number of convoluted elements, and it is very difficult to identify only one and say the US is due to this one. So it could be the size of the debt market, the fact that the US is an international currency, and so on. But we at least identify some of them separately. So basically, to conclude, we find that the safe asset fundamentals include inertia, that is particularly important, political risk, and crucially, the relative size of the debt market. Depth and liquidity of the debt market may be particularly important. There are also other relevant fundamentals which may be different across time, before the crisis, after the global financial crisis, and across advanced and emerging markets. The special role of the US cannot be coded by a single fundamental, as just mentioned. And finally, the fourth point that has not been analyzed, but is studied in depth in the studies, that the shocks that they drive the change in volatility, they do not seem to matter for identifying the fundamentals. To conclude with some policy implications, we see that, of course, some fundamentals, like political risk and the size of debt market, may be influenced by policymakers. So maybe the larger debt market is something that may be influenced by policymakers. And in particular, this is linked to the second point, that we have seen that the relative size of the debt market, is the fact that it is larger relative to other one. So you may think, for instance, of the difference between the fact that the Swiss debt market, the fact that the investors, they cannot really find Swiss government securities in a crisis period because it's a small country compared to the size of the US Treasury market. This is important, but that means that only a limited number of actors may really rise to the role of a safe haven. And this, of course, implications for the creation of European or Euro area safe assets, and an interesting aspect. Thank you, Ambrogio.
Thank you very much, Maurizio. We have a few minutes for questions. Attendees, please feel free to write in the Q&A box. And panelists, you can unmute yourself if you have questions for Maurizio.
Ambrogio, I have a question for Maurizio, just a quick one.
Please.
So I think these results are quite intuitive, and they're in terms of the regression coefficients, but I was wondering if that could be, the analysis could be pushed further to think about which ones are actually necessary condition for the assets to be safe assets, and which ones are just happen to be correlates. Like, I don't know what's an easy way, or if there is an easy way of doing that. But maybe there's some kind of non-linearity there that like you absolutely need to be large, or maybe that's not the case because we have Swiss assets, or maybe you absolutely, the asset has to be stable, or, and given the importance of inertia, how would a new asset become a safe asset?
If I may add to that, I think I had a similar reaction to Galina's, especially on the inertia term. So I struggle to think of inertia as being a fundamental of safe assets. So shall I think of that as maybe some factor that you guys can't capture with observables, and so there are other kind of dimensions that matter for what makes an asset a safe asset. So just follow up on Galina's point.
Thanks. Of course, these are very good questions and suggestions. On the whether they are necessary or sufficient is difficult to test. I can say what is my intuition. I will need to think about it, how to test this. My intuition is that you see basically some strengths of some characteristics compared to others. Let's put it like this. The size of the debt market, I would say that is something like a necessary condition for a global safe assets, so that it is in the interest of all global investors. May not be a necessary condition in general, because for instance, you may have that the Swiss franc and that appreciates and doesn't have to be really large, but eventually not all global investors, they may run through into Swiss securities. So this is more basically to look basically with more details, but it's an interesting question, and of course also the one of non-linearity. The inertia term, yes, perfectly right. We thought about it. That is not the right. Is not into. It doesn't fall into the right term of a fundamental. It's not a fundamental, but it plays a lot into what the literature is discussing. So the fact that there is an element of coordination, and there is an element of bubble-like, basically, behavior of safe assets. When all the investors, when there is volatility, and I don't think anybody starts to look at the fundamentals, at the specific macroeconomic fundamentals of Japan. They just buy the Japanese yen, because they know that the correlation is there. The correlation is there that the Japanese yen will appreciate. So that is the type. This is the type of behavior. It is sure it is not a fundamental. It's not the right term. It's more a sort of a characteristics. But it's something that I think is also, in terms of economic significance, is not very high. It was also in the paper on the safe haven currency, but it's incredible how statistically significant it is. This is what we found. It was exactly the same also for safe haven currencies, that you would find the same type of statistical significance.
Maurizio, thank you very much. I think we have less than a minute left in the session. So before the session shuts down, let me just thank all participants, all the panelists, all the attendees for the questions and the discussions. It's been great to have you. Galina, you might want to say something, or we just close it here.
Yes, I'd like to maybe plug in a little advertising. So this session was organized by the CEBRA IFM program. In addition to the sessions in the CEBRA annual meetings, we also have annual program meetings. And this year it's joined with Riksbank and CPR. So please just go to CEBRA website for the program and register. It's going to be fully online, just like this conference, and it's October 1st and 2nd. And I would like to also extend my thanks to all the participants and the attendees, and thanks everyone for participation and presentations.
Many thanks to everybody.
Thank you very much, and see you hopefully very soon. All.
Hopefully, yeah.
In person.